Hi everyone, I'm Kyle Bechet, and this is the AAF Exchange, a podcast from the American Action Forum, where experts provide clear, data-driven insights into today's economic and domestic policy issues. Welcome, and thank you for tuning in. While the nation's focus is rightly on the devastating situation in Israel and the vote to elect a new Speaker of the House, we can't lose sight of less urgent, but nevertheless critically important domestic policy issues before us. On this episode of the AAF Exchange, we will discuss the unprecedented scale and scope of regulatory actions of the Securities and Exchange Commission. Joining us to discuss this is AAF Director of Financial Service Policy, Thomas Kingsley. Thomas, thanks for joining us.
Good morning, Kyle.
Thanks. So it's been a while having you on, but it's good to have you back.
I love your fancy new setup.
Yeah, I know. The last time I think you were on, we did it on like a team. We were still on Teams, and so now we're.
May those days never return.
Yeah. We did one. I had a Teams meeting the other day. I'm like, I hate this. I'd rather be in person and actually talking to somebody. So this is much better. But we always love having you on because you have always some great insight on the areas you follow. So, Thomas, let's begin by providing some context here. Would you give us an overview of, the key rulemakings that have been proposed and implemented by the SEC under the current chair and the potential impact on the economy?
Of course. So, at the highest possible level, in April 2021, Gary Gensler ascended to his SEC throne. And since that time, we have seen an astonishing number of rulemakings covering a very wide array of subjects. Things from private markets to stock markets to even environmental disclosures. But not just that. It's not just the topics that the SEC has covered. It is the sheer number of rulemakings we've seen and the way in which they have been promulgated that causes some concern. So in some 50-odd rulemakings, the SEC has added about $6 billion in increased annualized cost to industry and added an additional 6 million in compliance hours, which would be staggering in any time, let alone now. And that, I think, is what we want to get to, which is that this provides, at the end of the day, the crux of the matter is that, in my view, the SEC under Gensler has added more uncertainty to the markets than it has taken away. Right. And I think that's what we need to be worried about at this moment as we look into the possibilities of a soft landing than ever.
Yeah, I mean, I just to broaden it out a little bit, our great regulations team tracks this weekly, and it's just staggering to see the number of regulations coming out of every department in this administration, but even more so in the SEC. And I know that's, you don't follow all the regulations here, but it's just, it's just emblematic of the broad usage of the rulemaking powers.
Exactly. And as you say, it's not just the SEC. So when we look, for instance, at something like the Federal Reserve, and I believe some members of Congress were talking about adding an environmental mandate to the Federal Reserve, we are seeing this expansion in the scope of all of our agencies, and I think that is a significant cause for concern.
Yeah. You outlined a few areas in your piece that you did recently, and of course we'll provide a link to that for anybody who's interested. And it's a great piece; everyone should go read it. Where you see the overreach from the SEC. Could you just elaborate for us today on those rules that have garnered that significant attention, and explain why they're generating this kind of controversy?
Of course. So let's break this down into two parts. Part one is what the SEC is doing and talking about, and then let's go into a bit more detail in part two as to how they're going about it that is raising some eyebrows. So just taking two examples from the SEC's ambitious regulatory agenda. The first and probably most prominent piece is the SEC's proposed rule regulating environmental disclosures. So in March 2022, they released a proposed rule that would require all public companies operating in the US to provide climate-related information in both their registration statements and their annual reporting. These disclosures would require businesses to provide data to their investors and consumers on the climate-related risks they face, their governance and risk management processes in place to mitigate these risks, and their greenhouse gas emissions. And at the risk of getting too granular, the proposed rule went so much further than anyone expected by expanding to cover scope Pillar 3 emissions, which we won't get into, but essentially this is not just your business's greenhouse gas emissions, but the greenhouse gas emissions of everyone that you do business with, your entire supply chain. This is an astonishingly complicated and vast proposal out of the SEC. And at the end of the day, forgive me if I go on about this, I find it fascinating, we're talking about the financial risks that stem from climate anyway, which is notoriously difficult to model. So essentially, it's going to be garbage data going in, garbage information coming out.
Yeah.
So
seems like a lot of guesswork there.
It's entirely guesswork, and the insurance industry is not unfamiliar with the business of guessing climate-related disasters. So that part isn't entirely a surprise, but what it does is, amongst many other things, is it diminishes the work that industry has already done to provide much of this information voluntarily by imposing from on high a single standard template that won't fit everyone and won't return good results in an attempt to compare apples and oranges. So taking as an example that one, and we can come back to why there are other controversial aspects of that in a moment, but just keeping things snappy. Let's also talk briefly about my favorite of all possible topics, crypto. So for those who haven't been following, it has been an interesting time in crypto, and we are seeing some of those headlines again at the moment because of the trial of Sam Bankman-Fried. I hope that poor boy has managed to get his ADHD medication. That was an evil giggle, Kyle.
I was not expecting the line, and I had to.
So, again, trying to keep this relatively high level. At the end of the day, crypto is a de novo industry, and de novo industries require de novo regulation. We haven't seen that. There are a wide variety of quite interesting policy reasons why that hasn't been the case. It boils down to how we should appropriately treat digital assets. To cut a very long, boring story short, are they securities, or such that they should be regulated by the SEC, by Gary Gensler, or are they commodities and they should be regulated by the CFTC? What we really need, or what industry really needs, is for Congress to come down and set a series of guidelines or rules, and ideally an overarching whole-of-government holistic approach to crypto and digital asset regulation. We haven't seen that. There have been a couple of attempts, and Congress is still trying. I wish they'd try a bit harder, but I understand they've got other things on their mind. Yeah. In lieu of that, or perhaps because of that, we are seeing what amounts to a regulatory land grab from some of the agencies, notably the CFTC and the SEC. And so Gary Gensler has basically come out and said that his agency has the authority, which is questionable, to regulate vast swaths of the crypto industry, basically because he says so. He may even be right, but it is deeply concerning to me that that should be the position simply on his word.
Yeah.
So those are some of the big topics that the SEC is looking at, and interesting that neither of them seem to fall that clearly within the mandate of the SEC currently, but surprisingly, that's not even my point. Let's talk just very briefly about the way in which the SEC is going about these things. As I mentioned, we've seen some 50-odd rules finalized in the brief period since Gary Gensler became chair, and this figure is roughly double that of his predecessors, who were working against the backdrop of a wide-scale financial collapse. Slightly more troublingly, and let me pull out my research on this, or I say my research on this. It was actually a really fantastic study done by the Committee on Capital Markets Regulation. So they analyzed the SEC rulemakings under Gensler, and they found that this was the really staggering statistic. Only 17% of all of the rulemakings that Gary Gensler promulgated were actually required by statute. Everything else the SEC has done under Chair Gensler has been entirely of the agency's own volition. And this is an astonishingly heavy workload on any agency, even the healthy ones. And at the risk of getting into gossip, the SEC, of all the financial services regulators, has seen an astonishing amount of staff turnover. So questions as to the health of the SEC remain. But this is where we start to get into the meat and bones of what I find fascinating, which is that not only are so many of these regulations not obviously required by statute, but they may even contravene it. So on topics like the ESG proposals, we have the Administrative Procedure Act, which requires that rulemakings be issued within the jurisdiction delegated to the agency and as authorized by law. And we are seeing a number of constitutional challenges to the SEC and other activist regulators in the specific mandate from which many of these rules flow. And then I think the final thing I just want to touch on the more vanilla rulemaking side, and apologies, I will get back to you in a second, is that the way in which we're going about this. So cutting down the procedures of the agencies very quickly. typically what happens is an agency will issue a proposed rule and allow public to comment on it. And there'll be a comment period of, say, 60 to 90 days. The Financial Services Forum in early 2022 found that Chair Gensler had given the public an average comment period of about 38 days, which is an astonishingly fast time for industry to comment on these rules that have the potential to upend everything that they're working towards. So we're seeing a lack of deference towards the traditional rulemaking process. And the last thing I want to leave you on is what's the worst thing than an SEC rulemaking process? When we don't even bother with that. So what we're seeing is increased regulation by guidance, which is the sort of what's a good way? Ancillary words that an agency will release in order to help explain its rulemakings. We're seeing an astonishing amount of regulation by enforcement. We've seen this with crypto. We've seen this with the SEC's attacks on Binance and other crypto agencies. And creating a legislative framework out of enforcement is one of the worst ways of doing it. Even on just like the chattiest way of looking at it, we have Gensler just this weekend released some remarks about the need to regulate AI. He may even be correct. It is not clear that the SEC has the authority to do so or should.
It sounds like it's just a lot of this. It's this mentality that they have to be proactive and have their hands in everything and just trying to regulate everything that they possibly can get their hands on at this point.
Exactly. Fair play to them. I think, and Doug might disagree with me, which, if you hear me screaming later, you'll know why. But it is not unusual for the agencies to attempt to fulfill the political goals of the administration that put them in place. That is not inherently odd. What is disappointing to see is us abridging the appropriate procedures in getting to that position. Mm-hmm. And not only that, but we have to talk about what the appropriate scope, what the appropriate role of the agencies is, because the trend is only larger.
Yeah. I mean, I'm trying to think back to Dan Bosch, our former colleague, who was in charge, who was our director of regulatory policy previous to Dan Goldbeck, did this great video about the regulatory rulemaking process. And when you said the amount of days it took him to do all of this, I don't remember the exact day, but it just seems way too short.
It is an astonishingly short amount of time. And so one of the things we are seeing most from industry now is, could we please have a little bit more time?
Yeah.
Because, particularly these days when you have an army of lawyers and you want to think about the implications that the SEC will have on your business, mm-hmm. to say you have 40 days with which to put in a comment, which, frankly, we may ignore anyway, but that's aside the point, before we upend the entire way in which you do business.
Right. I mean, yeah, because we want our policymakers to be thinking through what are the unintended consequences of these actions? What are the intended consequences of these actions, and how will they affect every aspect of different parts of our lives and our economy?
That is exactly right. And if I can just jump on that for 1 second, one thing we are seeing, or I'm seeing in the financial services space with the SEC and the Federal Reserve, is that I don't remember an administration or the agencies of an administration who have issued rulemakings in such a way that seems to have no consideration for cost. So it's not even just consequences, intended or otherwise. There seems to be this idea, when we look at, diverting slightly, when we look at the Federal Reserve's approach to bank capital requirements, you need to hold bank capital because it will make you safer. We increase bank capital because it will make you safer. Now, we can debate until the cows come home whether or not that is true. Sidebar, it isn't. But the point is, I have never seen the agencies be so blithe as to the cost ramifications of the rules that they are pushing out onto business.
Mm-hmm. As somebody who grew up in Vermont around a lot of cows, I always appreciate when you bring in that saying, until the cows come home. I don't hear it quite enough. Reminds me of home a little bit. All right. Well, so, these are real potential impacts. There are real potential impacts, and let's, dive into them a little bit. Of these kind of rulemaking on industry, market activity, and investor confidence. So could you just shed some light on how these rules affect businesses and investors?
Yes, absolutely. And I'll keep this one brief, I promise. At the end of the day, there isn't much to say here beyond the fact that we are dealing with a massive decrease in industry certainty, because at any day, Chair Gensler could hop on CNN and say, you know what, let's get rid of cards. That was a bad example. However, my point is, outside of the formalized rulemaking process, and even within it, when it is being abused to this extent, the time periods and the size of the rulemakings, the potential escape, the potential implications are increasing, and the ability of business to react is decreasing. This is only bad. And my concern is that, and I'm not an economist, I'm a lawyer, I apologize for my sins, but to me what's really fascinating is that on the broader scope, what we are seeing some economists begin to believe that a soft landing for the economy is more possible. I'm not entirely certain that we can count Doug within that number, but I haven't heard him on that one recently. But what is fascinating to me is that although we are seeing some figures suggesting that the economy is doing much better than many have to say for themselves, labor figures, so on, I am staggered by the degree of pessimism we're seeing from our business leaders, from Jamie Dimon and other folks like that. We are seeing plenty of signals from the banking and other financial sectors world that, for instance, we're going to see a decrease in availability of credit over the rest of the year. We are seeing risk tolerances decrease. The large banks are looking at things like the bank capital regime coming down the pipeline and shutting up shop. And I think that is astonishingly worrying for so many reasons. And as I said before, would be even were the economy at its healthiest. I think that is what I mean when I say the unintended ramifications or a lack of regard to costs that we're seeing, because we are essentially freezing business. Business will go overseas. There will be a decrease in loan availability. The implications on the housing market don't even bear thinking about. And that's what I'm nervous. I hope, like everyone does, that we do manage a soft landing. I am concerned that the pace and scope of rulemaking at an agency level is making that less likely rather than more. Less likely? Yeah, you got the point.
Yes. So you mentioned you mentioned earlier a lot of these rules have faced legal challenges. You said you're a lawyer, so now I'm going to make you live up to your sins here. What are some of the notable cases of pushback or legal challenges against these rulemakings?
It's a great question, and here is my 7-hour PowerPoint I have provided on the subject. I think a couple of things I find really interesting here. And first of all, let's take half a step back and just say it is fascinating to me that it has been the courts, that via the medium of the courts, that we are seeing pushback, because we're not seeing it in any other way. So it's fascinating to me that we're even in a position where any degree of remediation is coming out of the Supreme Court. Let's start there. Two interesting Supreme Court cases I think it's worth bringing to your attention. The first would be the Supreme Court on its docket for its next session has two cases that will have implications for the SEC, at least. The first is somewhat narrower. The SEC, like a number of other agencies, has essentially an internal court system that allows it to enforce or try some of the cases that come under its jurisdiction. And that is, legally speaking, extraordinarily complicated. If nothing else, at the top level, it allows the SEC to act as judge, jury, and executioner of its own rules, which is not typically a great thing. And so the SEC is coming at the Supreme Court is about to hear a case that is going to look at the very constitutionality of the SEC's internal courts and the other agencies that have a similar setup. And this is fascinating to me because, on the one hand, if the Supreme Court does strike down this mechanism, which is not outside of the realms of possibility, we are going to have to re-examine every case that these courts have seen, which would be a disaster. But it would also be the correct response, and thankfully someone else's problem. So that's a more niche example. On a broader example of, again, another case going before the Supreme Court that I'm very fascinated in would be the Chevron doctrine. Are you familiar with this,
yes,
Kyle?
We've talked about the Chevron doctrine before on the podcast, and so obviously it's been a hot button topic since the current court really started looking at some of these issues.
Exactly, and I think just for anyone who's not familiar, literally the 30-second explanation is that since about the 1980s, as a way to grease up the wheels of bureaucracy, the requirements of the Chevron doctrine came down such that federal courts have to defer to an agency's own interpretation as to whether or not the rules it puts out are within mandate. And while a good idea because at the end of the day, and Gordon and I disagree on this, the degree to which Congress is capable of issuing requirements to every agency such that every agency only works within the express guidelines of Congress, I think a degree of fudging is necessary just to make everyone's life a little bit easier. But having said that, we have seen so many cases where the Chevron doctrine has been taken to frankly unbelievable extents, and the ESG case out of the SEC and AI and crypto are all good examples of this. Putting aside for a second the merits of any of these cases, in and of themselves, which is fine, there are simply too many questions about the SEC's authority to have an opinion on these matters at all. So I think the SEC should be possibly the most concerned of literally any federal agency about the potential implications of a Chevron case. And I'm happy to fight any AAF policy director who disagrees.
That could be some good entertainment. Maybe we have that on the podcast, and I could just sit here with Doug and watch you all fight about it.
Legally speaking, I didn't suggest it.
Yeah, perfect. Yeah, for legal purposes. There's the lawyer. All right, so let's end the podcast today by just talking about the future a little bit and what it might hold for these SEC rulemakings. What can we expect going forward? And are there potential solutions, alternatives to these kind of rulemaking?
So do watch out for the SEC cases. I think they're going to be fascinating. I'm very interested to see where they land. Other than that, we don't often talk about politics of the AAF. We try and stick straight to the policy. But I think there are two ramifications for the SEC, at least in the short term, that are very interesting and worth following. The first is the Congressional Review Act. Again, this won't be a surprising term to many who follow the AAF's work, but essentially this is the period of time which allows a following administration or regulatory body to undo the work of the one that came before it.
Right.
And so at some point, it makes it significantly easier for them to do so. So at some point, we are getting into what is called the CRA period, where it becomes significantly easier to unwind the work of activist agencies. And so it behooves the SEC and other similar bodies to get their work out as quickly as possible to avoid that period. That's all I'll say about that. Secondly, we are, of course, looking at the potential for another government shutdown. And who knows how long it could be. Oh, sorry, I say another government shutdown. We did technically avoid the last one, I think by an hour or so. A government shutdown.
Well, another one in the history of government shutdowns. Correct. We've had quite a few since,
And when we approached the last government shutdown, which thankfully didn't happen, one thing that I found quite revealing was that, forgive me, I don't remember the statistic offhand, but it was something like it was either 80% or 90% of all SEC staff face getting furloughed, which is high, which from my perspective, obviously that's going to put an enormous spanner in the works for the SEC and their ability to continue getting out these rules. When I chatted about this with Doug, he also raised the excellent point of, if 90% are going to be furloughed, they can't actually be that vital, can they, if they're not necessary? But, that's an aside. So I think I definitely see challenges in the sheer workload of the SEC in the short term. I think the only other sort of thing I would like to point out is by far the most significant rule that the SEC is pushing down is this ESG disclosure requirement, and they have committed to getting it to us in the next month or two. Mm-hmm. So I think it is likely that a rule of some kind will come to us, provided that there isn't a government shutdown, and it is the single most interesting thing the SEC has done in decades. So that to watch out for.
On the workload point, and you also mentioned earlier in the podcast a few questions ago that there's also a high turnover rate there. So I mean that's got to also be playing a role in their ability to get some of these rules done and out the door.
Exactly, but that is very much the current workload of the SEC. At the end of the day, they have still already put out 50.
Yeah.
So
it's hasn't slowed them down yet.
not till now.
So, okay, final question for you. What would be your advice to policymakers and regulators considering these developments, and what should businesses and investors be mindful of?
So, taking both of those things in turn, just very briefly, first of all, and this comes back to the Chevron doctrine, and we are not constitutional scholars here at the AAF, so I will leave the exact bounds of where discretion should and should not be applied to my betters. But it does raise fascinating questions as to what we want our regulatory agencies to be, what we want them to do, and the powers that we want them to exercise. At the end of the day, I would prefer those questions be addressed by Congress than by the agencies themselves. So what we're looking at is, and I know Congress is not only busy, but dare I say more dysfunctional of late, but ideally I believe that Congress needs to sit down and have a look at these agencies and really assess what role they wanted to have for the economy and for the businesses they regulate. For the businesses themselves, there isn't really much to say other than good luck, guys. I realize that doesn't sound particularly helpful, but I think what I would, and again, I would defer to the economists on this, but what I would caution you is that things, I'm seeing more pessimism in the industry than I've seen, well, since or even including the financial crisis. For a long time, particularly with the largest possible banks, a rule would come down, it would be onerous, misapplied, unhelpful to their business and their customers, but they would shrug it off because they had the compliance departments to absorb the cost of these rules anyway. Those rules would be passed on to consumers. Competition would decrease. We would all be worse off. But that was very much the understood way, and things didn't change. What I'm seeing right now is very much a slightly odd, the sky is falling vibe, and it's not entirely clear to me that it's justified. So I think businesses are in a rough way with the scope, the speed, and the scale of the rules that are coming their way. But I think they do have a role in trying to maintain the ship, and chin up, guys.
Good luck to you. It just seems like, again, I would keep coming back to it, but the pace and the sheer number of these rulemakings just makes it very tough to do, to plan for the future and figure out what comes next in the economy.
Exactly. And what that means, if you can't plan for the future, is that you have to be more cautious. You have to reserve more, which is, obviously terribly good business practice, but those costs will inevitably be borne by consumers.
Excellent. Well, Thomas, thank you for coming on the AAF Exchange podcast today and talking us through all these issues.
Thank you, Kyle.
I hope you enjoyed this conversation. Tune back in for our next episode, where our experts will provide clear, data-driven insights into today's economic and domestic issues. I'd also encourage you to check out any of the links in our show notes, and also follow us on social media to learn more about AAF. Don't forget to subscribe on iTunes, Spotify, or Google Play.